Hi everyone, welcome to Be Different for Success. Today we'll be talking about why most traders lose money. A commonly known fact is that a significant amount of traders fail. Various websites and blogs even go as far as to say that 70%, 80%, and even more than 90% of Forex traders lose money and end up quitting. To the naked eye, trading seems like an easy way to make money. In fact, over the past 10 years, you can see a positive trend on the graph for both the New York Stock Exchange and NASDAQ. But what many people don't know is that 90% of traders lose money. Over the long run, they tend to diminish their accounts while the stock market goes up. The question is why? Why are people losing money if it seems like the market is doing so well? The answer is lack of skills and knowledge. 90% of retail traders lose money. This is not the case for pro traders. The key for the average person is to be the retail trader, but to trade like a pro. You can decide to trade like a professional and jump into the top 10% of retail traders. The question is, do you have what it takes to be part of the elite 10%? Reviewing the following list will show you some of the most common reasons why traders lose money and help you become a part of the top percentile of winning traders. Number 1. Overconfidence. Most investors are overconfident in their abilities, which leads them to trade more aggressively, take on more risks, and ultimately lose more money. A study conducted in 2019 found that when stock traders were successful and made a profit, they disproportionately attributed success to their ability rather than luck. At the opposite end, when traders lost money, they often attributed it to bad luck and downplay their losses. This leads them to want to keep going. Overconfidence like this is dangerous. It makes you more likely to jump into a trade without doing enough research, or stay in a trade for too long when you don't want to admit that maybe you were wrong. When investing, I often say that ego is your worst enemy, and admitting to yourself that you were wrong about something is a hard pill to swallow. With trading, your emotions are likely the hardest barrier to overcome. Anytime you invest, there are 4 emotions that will creep up: hope, greed, fear, and regret. Often these emotions will overpower any amount of logic you possess. Number 2. Getting in too late. When Bitcoin shot up in 2017, people were intrigued. People started to see the potential for economic gain when the cryptocurrency went up by hundreds of percent. It seemed like an easy way to make money since a large pool of people multiplied their accounts. By the time the average person decided to join the game of trading Bitcoin, it was already too late. Yes, there was a nice amount of people who made money off trading Bitcoin, but the majority of people joined the market when it was at its peak or almost there. After the crash of the cryptocurrency, millions of people lost money on their trades. Number 3. Too much social. Trading is not supposed to be social. It's a game. And in every game, there are winners and losers. Don't follow what everyone has to say. Be true to what works for you and win the game. Social influence plays a major part in why people lose money. For example, even if you did know that Bitcoin was going to crash at X amount of percent, it would be still hard for you to sell your position. The social pressure you would receive from friends and colleagues could still influence your decision. They can say, "Why would you sell? Look how much money we are making." This may seem like a joke to you, but this is the reality for many. You don't want to be that guy who loses out on making money while all the people you know are making a profit. Number 4. Surprises. There are 2 types of surprises when it comes to the stock market: unscheduled events, tweets and news; scheduled events, economic events. There is a lot to keep up with when it comes to the markets. You constantly have to be aware of the news and even keep up with unexpected events such as tweets. Even scheduled events can many times have a stronger effect on the market than expected. Many traders lose money after news releases because they don't have the appropriate tools for trading. Number 5. Absence of risk-reward skills. Many traders get in on bad trades. They don't understand enough about the market and just invest in a belief that the market will eventually go up. Many times that is not the case, and one should be aware of how to treat risk versus rewards. Many traders don't follow their plan due to their emotions. When their trade starts going in a negative trajectory, people will place their stop loss lower in hope that their trade will bounce back up. Traders need to know that it takes time to estimate trades before initiating them. Getting emotional when trading is one of the worst things that a trader can do. One needs to be patient and follow their game plan. Number 6. Befriending the market. The market is not something you beat, but something you understand and join when a trend is defined. At the same time, the market is something that can shake you out if you are trying to get too much from it with too little capital. Having the beating the market mindset often causes traders to trade too aggressively or go against trends, which is a sure recipe for disaster. Number 7. Low startup capital. Most currency traders start out looking for a way to get out of debt or to make easy money. You must have some money to make some money. However, with only a small amount of capital and outsized risk, you will find yourself being emotional with each swing of the market's ups and downs. You can resolve this issue by never trading with too small of an amount of capital. This limitation is a difficult problem to get around for someone that wants to start trading on a shoestring budget. Number 8. Giving in to greed. Some traders feel that they need to squeeze out every last dime in the market. There is money to be made in the markets every day. Trying to grab every last dime can cause you to hold positions too long and set you up to lose the profitable trade that you are trading. The solution seems obvious. Don't be greedy. Stocks continue to move every day. The next opportunity is right around the corner. Number 9. Refusing to be wrong. Some trades just don't work out. It is human nature to want to be right, but sometimes you just aren't. As a trader, you just have to accept that you're wrong sometimes and move on, instead of clinging to being right and ending up with a zero-balance trading account. It is a difficult thing to do, but sometimes you just have to admit that you made a mistake. Either you entered the trade for the wrong reasons, or it just didn't work out the way you planned it. Either way, the best thing to do is admit the mistake and move on to the next opportunity. Number 10. Buying a system. There are many so-called trading systems for sale on the internet. Some traders are out there looking for the ever-elusive 100% accurate trading system. They keep buying systems and trying them until finally giving up, deciding that there is no way to win. As a new trader, you must accept that there is no such thing as a free lunch. Winning at trading takes work, just like anything else. You can find success by building your method, strategy, and system instead of buying worthless systems on the internet from less than reputable marketers. Summary. After going over these points, it's very obvious why traders fail. More often than not, trading decisions are not based on sound research or tested trading methods, but rather on emotions or the need to make $1 million in your underwear. What traders always forget is that trading is a profession and requires skills that need to be developed over years. Now, if you're convinced that it is better to trade as a pro, here is what is required. To be a pro trader is required patience, learning, appropriate toolbox. If you follow these steps, it will be much easier to find yourself making a profit as opposed to being one of the many that lose money on their accounts and just never recover. Therefore, be mindful about your trading decisions and the view you have on trading. Thanks for watching this video. I hope you liked it. Please click the thumbs up and write your personal tips in the comments below. Thank you for your support. And don't forget to subscribe to the channel if you want to hear more from us. See you in the next video.